You're getting consistent cash flow. Just like the lender, you should be getting your payments every single month. But you also participate in the profit on the back end when the property sells or the property refinances. You're going to get a bucket of cash as well. So you get kind of all the benefits of the equity side. So it really is a good blend of debt and equity benefits.
Welcome to the Bar Down Investing Show. Here are your hosts, Kyle Wilson and Jay Scott.
Hey there, and welcome to another episode of the Bar Down Investing Show. I am Kyle, also known as Ashley Wilson's husband, and I have here with me the webinar wizard himself, Mr. Jay Scott. How's it going, Jay?
Good. I'm not sure I like that nickname, webinar wizard. You can do better.
Well, you did a webinar last night, and I thought you crushed it. So I thought it was a fitting nickname.
Okay, I'll take it. We can work on it, but I mean, it makes me sound a little geeky and nerdy, which I guess fits. But I'm trying to change my persona here.
Yeah. Is that what you're going for with that look? Okay, fair enough. Well, I'll roll it right into the check-ins and wins because I have a feeling I know what you're going to say for your win.
Wait a second. No, we can't go there yet. I haven't.
Why not?
I have another announcement to make.
Oh, you're not going to wish me happy birthday, are you?
Happy birthday! Today is your birthday.
You did that last week, though, so it's not fair. You can't do it twice.
Last week, I wished you happy birthday because that episode was releasing today, which it did, and today's your birthday. So you get a birthday wish on the episode, and you get a birthday wish live.
Yeah, I guess we're on kind of the short week football schedule where we recorded last Sunday, and now we're doing it again Thursday. But thank you again for my happy birthday. I promise next week will not be my birthday as well.
We'll see.
Okay, let's get into the wins. What do you got for wins this week, Jay?
So I think I set the trend last week on wins that I'm going to talk about an investment that I'm doing that week. And I guess it's easy because the investment I did this week is an investment into a fund that Bar Down just launched. We launched our first fund. It's going to be a $50 million fund that we're going to invest in a wide array of assets, real estate assets. And we launched it yesterday. I guess that was the webinar you were talking about. And as always, we invest in our own fund. So that's my investment of the week. And I'll keep everybody updated on how that progresses.
Yeah, it's funny because I call you the webinar wizard, but I've never seen you so nervous for and presenting for a webinar. It's crazy. I'll go to conferences and you'll be standing up on stage in front of thousands of people presenting on a topic, and beforehand you're cool as a cucumber, and then just get up there and just do the presentation. But when you do this webinar on a computer in front of a bunch of blank screens, it's not even showing anybody's faces or anything. Then all of a sudden you're getting nervous. So I was. Even Jay Scott gets nervous.
It's a little different when you're trying to raise $50 million, I guess.
Well, I guess so. Yeah. All right. So that's a pretty good win. I'll take that. Scorecard. We're supposed to talk about how we're doing on the podcast, but our first podcast literally dropped a couple hours ago. So when I was trying to find out some data on that, Apple wouldn't even give us anything. The only thing I could find was YouTube. YouTube kind of keeps real-time data. And at the time of this recording, we had 8 listens on YouTube. I know only one of them was my mother. So I didn't listen to any more. I don't know how many times you listened, but we might have 7 unique listens on YouTube. So
we multiplied our subscribers, our listens 8 times over the last week. That is tremendous growth.
Easy with the subscribers. I don't know how many of those people are actually going to subscribe, but I'll take 8. 8 was better than 0. So than last week.
So anybody that's listening, what did my kids say? Smash that subscribe button. Smash that like and subscribe button.
Smash and like. Yeah, I don't know if the YouTube is going to be the platform that everyone goes to listen to us, but we'll see.
Give us a
rock updates. The rock updates are a little bit different tone than last week. Last week it was very upbeat about how I loved his movie. But this week, all in the news is Joe Rogan called him out saying he thinks he uses steroids. What do you think about that?
So I don't know The Rock. He's a big guy. Does Joe Rogan have any evidence that The Rock uses steroids? Or?
Well, so this all came about because of this guy, the Liver King. Do you know the Liver King?
We run in different circles, Kyle. I do not know the Liver King.
So the Liver King was an internet sensation because he's this guy who has no business being as big and as jacked as he is, and he just does these crazy antics online, and he does things where he goes like on an all meat diet, just eats all raw meat, and people were loving him because he's a bit of a clown, very eccentric. And anyway, he finally came out and admitted that he did steroids. And so Joe Rogan was commenting on that and somehow looped The Rock into that, saying the Rock has such a big platform. He has a duty to his fans to basically admit that all of this clean living and, working out at 4 a.m., that's not what's getting The Rock to his physique. The only way The Rock can have that kind of physique in his 50s is by doing steroids. And so that's how it all came out. And they both have very big followings, The Rock and Joe Rogan. So it's a very animated discussion going on.
I think we need a cage match.
I don't think even Joe Rogan wants to take on The Rock. He's got quite a bit of fighting experience, and as he mentioned, he is quite big. Yeah, so that's anyone. I'll keep you updated if we have any updates. If The Rock responds to that, maybe that'll be next week. Maybe he'll respond. But just everyone knows, I'll keep you in the loop on what's going on with The Rock. Okay, next, real estate headlines. This was a big week, an easy week to pull some headlines because we had two big announcements. Well, 2 days ago and yesterday. Tuesday we had inflation, and Wednesday we had the Fed funds announcement. What did Powell come out and have to say this week, Jay?
Yeah, so I don't want to say we predicted, it wasn't a difficult prediction, but as we predicted last week, Jerome Powell and the Fed announced a 50 basis point or half point rate hike, which is pretty much what everybody expected as well. But the surprising part was that he was a lot more aggressive in how he spoke about what's likely to happen over the next 6 to 12 months. I think a lot of people were expecting that with inflation kind of coming down, and we'll talk about that in a minute, that the Fed was going to kind of pivot and slow down and talk about how they're going to start cutting rates in the near future. But Jerome Powell basically came out and said, look, don't expect any rate cuts in 2023. In fact, we'll probably see another 1 or 2, maybe even 3 rate hikes in 2023, smaller hikes, but don't expect to see rates coming down anytime soon, because we really want to make sure that inflation is quashed before we do that. And so the markets didn't necessarily react favorably.
Yeah, he didn't take off the table that we're going to keep reducing the size of the rate hikes. People are now expecting the next hike, at least the next couple hikes, are going to be a quarter point. You never know. But yeah, Powell didn't seem too happy with how everyone reacted last time. Everyone basically thought that we'd beat inflation, and let's rally. And the stock market rallied. The S&P basically got up to around 4,000, and apparently Powell didn't like that. So he wanted to keep everyone in check while still doing his job of keeping inflation in check. So while he did slow down, he wanted to make sure that everyone knew he wasn't planning on pivoting anytime soon. And that goes off of the next headline, where the day before inflation came out. So that when the inflation numbers came out, it basically locked in that 50-point rate hike. There was always that off chance that the expectations were going to be way off and it was going to be much higher. And then all of a sudden he was going to pull a last minute pivot like he did back in, a few months ago. When the inflation numbers came right before, and he jumped from 75 they expected up to a full point, but that didn't happen. So what did we see in inflation this week?
Yeah, so the expectation was inflation numbers were going to come in at like 0.3% for the month, which translates to about 3.5% inflation.
And we're talking CPI here, not
yes,
PCE.
Not the core. And in reality, it came in at 0.1%, which translates to about 1.2% inflation per year if we had that same exact trend over the next 12 months. So a good bit less than everybody expected. I think the one big factor, if you actually dig into the different components of inflation, the one big factor was shelter, rent and housing. was up higher. That was the only component of inflation that actually for the month trended higher than the yearly average. I think that was up like 0.6%, so the equivalent of about 7% inflation in rents and housing growth for the month. But that goes back to what you were talking about last week, I think, Kyle, which is that typically housing lags the rest of the economy. And so I think if we can start to see housing slow down a little bit, and we're already seeing that on the ground, I think that's good news for inflation overall.
Yeah, if you just look at the lagging effect, I think we talked about it last week, as you mentioned. We had 3 months in a row of the Case-Shiller index was down, saying that housing prices had gone down 3 months in a row, and we saw the same thing in rents. Rents since August have been flat, sometimes a little bit down in certain areas. So we're not seeing that 0.6 increase in real time, and when that hits, we should see inflation go down even more. So that's good news for inflation. Moving on to some more real estate centered news, we have a lot of talk with housing costs going up. We don't have this booming market anymore. People are trying to cut wherever they can to try and get housing transactions done. And so once again in the news is the agents. Are they worthwhile? Are they too expensive? Should we cut them out altogether? So a bunch of articles surrounding that. And then one article in particular from Connect CRE that caught my eye was about how it's titled how pref equity can be profitable even in a downturn. So I flagged that one because that kind of goes towards what you just talked about in the webinar. So we have 4 topics here. Which one do you want to move to our issues list to discuss further?
I like how pref equity can be profitable even in a downturn, because this whole idea of pref equity, I think a lot of people first of all have no idea what that means. But I think it's going to be a hot topic over the next few months as people look to reduce their investment risk a little bit. And I know I've been talking about it for the last couple months. And so maybe we cover that one in the issues list and educate some people and talk about why we think pref equity is going to be a hot topic in the near future.
Yeah, I like it because the one thing about 2008, where of all the bad things that happened with that real estate crash, when the credit market seized up, people had to get creative and had to figure out other ways to get deals funded, and that's what a lot of new creative financing things popped out of that. So we're seeing some uncertainty in the markets right now. The credit markets are a little bit different than they were a year ago. So we're having to get a little bit creative with some other things, and pref equity is just one of those things. So let's move on to the issues list. And Jay, why don't you just give us a brief overview then of what exactly pref equity is?
Yeah. So I guess the best way to explain it, imagine you're buying a single family rental, simplest real estate purchase most of us make. And how are you going to finance that? Typically, you're going to go to a lender. You're going to get debt for about 75% of the total amount. So if you buy a $100,000 property, you're going to get a loan for about $75,000. And then you're going to need to come up with $25,000 in down payment. So that's what we call the equity portion. That's the part of the house that you actually own because you put in the money. Now, imagine on a big commercial deal, it's kind of the same thing. You're going to go to a lender, and let's say it's a $20 million deal. You may get a loan for 11, 12, 13 million dollars. And then you're going to bring together a whole bunch of investors to put in money to pay that down payment. And they're going to be the quote unquote equity holders. They're going to be the ones that own a portion of the property. And then every month you're going to collect a bunch of rent. You're going to pay a bunch of expenses. And then every month you're going to have money left over after all your expenses are paid. The first person that gets paid with that money that's left over is the lender. The lender is first to get paid. And then if there's any money left after the lender gets paid, that's what goes to all of your investors. And so being a lender is a pretty sweet position. It's pretty low risk because you get paid first. Every month you're going to get your mortgage payment regardless of how well the property did. As long as you don't want to get foreclosed on, property does well, property does poorly, the lender's always going to get paid. It's the investors that if the property does well, if there's going to be money left over, and they're going to get paid. And so that's how typically we finance deals. Well, with pref equity, what we do is we kind of carve out a space in between the lender and the equity holders, the passive investors. We carve out a separate class of shares. And so basically, we allow investors to come in and buy a class of shares right in between. So every month, after money's collected, expenses are paid, the lender's going to get paid first. But then before the rest of the investors get paid, this pref equity piece is going to get paid. So whoever invested as pref equity is going to get paid. So they're going to get paid second. And then if there's any money left over, then the regular investors are going to get paid. And so because pref equity, the preferred equity, is getting paid second right after the lender, before the rest of the investors, they're in a much safer position because they get their money before the rest of the investors. And so investing in that type of investment, that class of shares, is going to be a lot lower risk. And so typically for investors that are looking for a lower risk investment, for funds that looked for lower risk investments, a lot of times, especially when we have uncertainty in the market, uncertainty in the economy like we have these days, a lot of times operators are going to be willing to kind of carve out this separate class of shares in their deals, where investments can be made that are much lower risk, but still pretty strong returns.
Yeah, so it's a good middle ground, right? So when you're talking about the loan, the typical loan versus the equity, they're two extremes. So the loan is going to be extremely low risk. I mean, before 2008, it was considered same credit worthiness. A mortgage-backed security was the same credit worthiness almost as a U.S. Treasury. And it's very low risk, but it's also very low return. We're talking about 5%, 6% these days. Return for in exchange for that extremely low risk versus the equity, they take all the risk, and with all the risk comes all the profits, and so you're expecting somewhere in the teens as far as a return. So there's quite a delta from that 5-6% to the returns in the teens. What pref equity does is it kind of says, okay, is there a best of both worlds? Can I get a middle ground there? Can I reduce my risk, but also make a little bit more money than as far as the debt is concerned?
Yeah. I mean, in investing, we're always looking for what we refer to as optimal risk-adjusted returns. And basically what that means is risk and return are inextricably linked. They're intertwined. And if you want high returns, you got to take high risk. If you're willing to accept low returns, well, you can find some low risk deals. And so investors are kind of always looking for where's that sweet spot, where we get the best returns possible, but at the lowest risk. And so a lot of times people invest in real estate simply because real estate offers some tremendous risk-adjusted returns. I invest in multifamily because personally, I think multifamily offers some of the best risk-adjusted returns. But even so, when you go into periods of economic turmoil where the markets are kind of uncertain, we don't know where things are headed, sometimes we want a little bit less risk, even if we're willing to accept less return. And so what we've seen over, I guess, back to 2008, for several years after 2008, and then now, a lot of institutional investors, large investors, are turning to this pref equity type of investment to optimize their risk-adjusted returns. They're getting much lower risk based on these investments with a little bit lower return, but the ratio and the sweet spot is right there.
So what are some of the ways when you talk about lower risk? What are some of the ways that the risk is reduced by being in pref equity versus just a common equity on the capital stack?
Yeah, well, so the biggest one is typically just that you're getting paid first. Anytime you get paid sooner, you get money before the money runs out. So that's the biggest. But in addition to that, typically, if you manage the numbers well, you're only investing up to a certain, so we talk about this idea of LTV in the investing space. So a lender might lend up to 75% LTV, which means the asset can drop 25% in value before the lender takes any risk. Well, these days, lenders are pretty much, because interest rates are high, lenders are lending a whole lot less. They might be lending 55, 60% of the total value. Preferred equity can come in and kind of make up the next 10 or 15%, and you can still keep that total loan to value or total loan to cost at 75, 80%. And so basically the pref equity kind of steps in the same position that lenders were in just 6 or 12 months ago. So a lot of pref equity right now, it has the same risk profile as a lender did 6 or 12 months ago, which is a great place to be.
Yeah, and you touched on something briefly there too, where yes, it's extremely valuable for investors to come in and pref equity, but as an operator, sourcing pref equity from someone can be extremely valuable right now, especially because, as you said, with interest rates going up, that changes our debt coverage ratio, right? So when what we used to be able to underwrite in a property, we could get a loan from Fannie or Freddie for 75
Yep.
LTV. So we would only have to go out and raise 25% to cover up the rest of it. Well, now that same property, because the debt service cost has gone up significantly, sometimes almost double, um, then that LTV is kind of snuck down to, instead of 75, we're in the 50s most of the time. If you're lucky, you might be getting 60% LTV from that. So we have that 25% delta, or 15%, 20% delta in the money that you have to raise. Well, if you can have a pref equity come in and step in and cover that delta for you, then you're back to raising the same amount. And not only that, if you're in a bridge loan situation, you might be paying 8-9% these days as far as a bridge loan. Well, pref equity on the front end can come in and they can undercut that. They can charge you 7%
Per year.
as a coupon per year, instead of the debt that's coming in at 8 or 9, and your cash flow back to your common equity people is going to go up. Now you're going to have to pay a bit of a back end kicker on that, but if you're doing an IRR calculation, a lot of these investors would prefer cash flow along the way and be willing to sacrifice a little bit on the back end. So most investors are okay with that pref equity coming and stepping in, and it actually helps the operators make their numbers look better.
Yeah, and for anybody that didn't understand some of those technical terms there, and the long story short is that a lot of people describe preferred equity as kind of the best of both worlds between debt and equity. For the operator, a lot of times it looks like debt. It's very easy to forecast exactly how much it's going to cost you. It's relatively low cost. But on the investor side, it's a lot like equity in the sense that you're getting consistent cash flow. Just like the lender, you should be getting your payments every single month, but you also participate in the profit on the back end when the property sells or the property refinances. You're going to get a bucket of cash as well. So you get kind of all the benefits of the equity side. So it really is a good blend of debt and equity benefits. Plus, you have the downside risk, and that's probably the most important point for investors that are looking to really lower their risk profile and diversify into some lower risk stuff these days. So I expect, I mean, after 2008, we saw a lot of these types of investments because obviously everybody was looking for lower risk investments back then. Everybody was a little bit concerned about the economy, or a lot concerned. And so pref equity investments were really popular in 2008, 9, 10, even 11. But then we got to the point where nobody was worried about losing money. Nobody was looking for low risk investments. They were actually looking for really high risk investments because from 2013 to 2020, everything was making tons of money. And so we never heard about these preferred equity investments in that time period. But now that people are starting to think about risk again, and they're starting to get concerned about what's going to happen if the market changes, if rents go down, if vacancies go up, they're starting to think about how can I mitigate my risk a little bit. And so I think we're going to start seeing a lot of these preferred equity investments come back over the next 6 to 12 months.
Yeah, I personally have invested in some other higher equity pref funds, and to be honest, I keep a real close track on some of my investments, and those ones I don't as much, because I know that's going to be pretty standard cash flow, and in order for me to actually lose my investment on those deals, it would have to do extremely badly. It would have to be so bad that the operator bleeds through the entire common equity stack, which by design is about 20% of the entire equity stack, before it even touches my investment. So I really love those investments, regardless of
So
the not participating in that huge potential upside.
yeah, so basically what you just said there is the investment would have to lose 20% of its value before there was even a concern that the preferred equity piece would not get their profits.
Right. Yep. And in real estate, that's, there's some investments, if you're investing in businesses or if you're investing venture capital, things like that, there is that risk of drastic changes in value. But if you're talking about a change in value of 25%, and not only that, and the property has to sell right at that time, because there's no cash flow and all that time, it's such a low chance of happening, not zero, but a low chance of happening, that it just gives you a little bit more, what do they call it, sleep at night number. So you could be a little less worried about how your investment's doing. Great. I thought that was a great issues this week. We got anything on the to-do list for next week, Jay? Do you have what do we got for episodes coming up?
Yeah, so our Thursday episode this week, I have a great interview with Ryan Serhant. So anybody that doesn't know him, he's the host and the star of a show called $1 Million Listing. Basically, he is a super, super, super high net worth guy who is like broker to the stars, real estate broker to the stars in New York City, and we have a great discussion just about mindset and having a quote unquote winning mindset. Great interview. So check that out on Thursday. And I hope you checked out our first Drunk Real Estate episode from last week as well. We got some really good feedback on that from the two listeners that we had, the two subscribers that we had. Did have a couple people that listened to that and gave us some really good feedback. So that was fun to do, and hopefully fun for everybody to listen to.
Yeah, we love doing those ones. There's nothing; those aren't going away. We'll put it that way. We're gonna, even if people don't like them, we're gonna keep doing them, because there's nothing better than drinking and talking about real estate.
Yeah.
All right, let's wrap this one up. How would you rate this one compared to last week?
Well, I was leaning towards like a 7, but that whole segment on the rock kind of got me inspired, pumped me up a little bit. So I'm going to go with an 8.236 on this one this week.
You can always count on me to keep you updated, Jay. You never knew that you wanted to know so much about the rock, but now I could tell you're hooked. I'll give this an 8 as well. I thought it was right in line with the last week. We're not getting better yet, but we will get better with age. So that was great. How are we going to sign this off? You forced a quote out of me last week, but then you wouldn't tell me what you're going to do the week after. So
yeah,
what are we going to do now?
Your quote last week was life changing, and if I decide to get married again, I will like integrate that quote into my entire focus. So I'm going to go again with the quote. I want another one. I want to see if you can keep this up.
Another quote. Okay, so I'm a big movie guy, so I'm going to pull. I actually came a little bit prepared, thinking that maybe you'd do this. So I watched a movie the other week. I'm not gonna tell you what the movie is, though, so maybe you'll be able to figure it out. But a great line from the movie is one of the characters says, "A penny saved is worth two in the bush." So I'll let you.
He saved.
I'll leave that one with you to think about. But that was a great episode. Thanks for joining me here today, Jay. Thank you for everyone for suffering through it with us. Hopefully you'll come back with us next week, and we'll see you again in another week.
Thanks, everybody.